Welcome back to the hot seat. I'm delighted today to be joined by Philip Dragoumis, who's director and founder of Thera Wealth. Philip is a certified financial planner. Welcome, Philip.
Hi, David. Thanks for having me on.
So you've been a regular supporter of our live events since they came back in September. So many of our members might have had a chance to meet you in person. But for those who haven't, it'd be really interesting to hear a little bit more about your business that you set up.
Thanks. Yes. Well, I've been in financial services for 25 years, previously on the institutional side, but for the last 10 years working with private clients, and the last 6-7 years working with private clients in the UK mostly. This year, we set up Thera Wealth, which is an independent business. For us, that was really important to have a business that is purely focused on clients and is not restricted in any form, and is completely on the client side, as it were. We are really lucky to be supported by Valid Path Network, which is a long-standing supporter of independent financial planning businesses in the UK, and has been working for over 20 years, has a long track record in supporting these types of businesses. We are extremely, we think we're in a great position to offer clients truly independent wealth management.
Okay, terrific. Perhaps you could tell us a little bit about the different client types that you might look after and really what you add to each of those different types of scenarios.
Sure. Our overarching aim is to provide financial planning, first of all, for all the clients that we work with. So financial planning is something that not everybody, I think, practices, although they should. So the initial focus is to look at the client and what do they want, what are their goals, and what is driving them, what does the future look like, and if we can envision the client's future and then we can understand how we can get there, I think. So this is the first thing that we look at.
Is that distinct, do you think, from wealth management, where someone's got a portfolio of assets, but it's not looking at it based on really what they're trying to do or in any cohesive kind of way? That's
it. I mean, I say proper wealth management is based on three things, effectively: financial planning, which is what I just discussed. Then there's investment management, which is managing the investment, and then also tax planning, which is also important. So these three areas are key to a holistic approach to clients. I think a lot of people just focus on the investments. Some people just focus on the tax. We focus on all three, but the first thing that drives is the why. So why are clients investing? What's the point? What's the goal? If you don't know where you're going, then there's no point trying to pick which kind of vehicle we need to get there, whether it's a car or a train or thing. We need to focus on our destination, and then we can see what the best way is to get there. So that's why our primary focus is financial planning, and we create the financial plan. We look at it, we see, and by the end of the process, which involves getting very, very specific on the client's numbers, the income, outgoings, balance sheet, but getting, I like to get very, very exact on these things, because the more exact the inputs are, the better the outputs, effectively. So that's what we focus on, and then we come out with a plan. The plan will tell us if the client's goals are achievable or not. And if they are, brilliant. The client knows that he's got enough effectively to stop work when he wants to, or to achieve other goals. And knowing that you have enough is arguably more important than having enough. So if they know that, then they're in a good position to live the rest of their life as they want. So after that, we look at the plan, and then the plan will come out. We'll bring out some recommendations, which we'll then advise on. So the recommendations could be on investments, it could be on protection, it could be on legacy issues, it could be on tax issues. But the ultimate aim is to get where we're going, so reaching our goals, and that's why I'm here, and why wealth management exists as a practice, or financial planning, as it were.
Interesting. I mean, taking like a client, like a sort of city professional, I imagine they have issues like making sure they're remembering to do their ISA, their pension planning, their high earning today, planning for the future. They've got a different profile to a business owner or entrepreneur who has their own kind of cash flow and investment plans. I mean, what sort of things do you talk to city professionals about?
Yeah, so professionals are our main clients, our main client base, sort of 40s, 50s professionals. They've worked a number of years, and now they're looking at the future and at ways to make work optional in the future. So that's what we're trying to get at. Yes, you know, everybody has different needs at the end of the day, but the overarching themes are, you know, are you doing everything you can from a tax perspective? Are you contributing enough so that your goals are achievable or not? And if you are, and that's all sorted, you know, then we need to look at you know, longer term legacy issues for your children, and for their children and their education and everything. So that's something that we look at. I mean, specifically for the types of clients we work with, typically with very large organizations, they are remunerated quite often with stock in their business, especially for the big US firms. And this creates a risk, you know, a potential risk for their plan and for their financial plans if they are overly concentrated in their employer's stock. So this is something that we look at. We not advise, obviously. We don't give specific advice on specific shares. However, we do bring clients to understand risk and whether you know, and whether they can potentially risk, you know, meet their goals by having very large allocations in their employer stock. So that's something that we focus on. Clearly, tax is extremely important in financial returns in the UK. If you're not doing your tax right, then it doesn't really matter where you're investing or what you're or what you're doing. It can add up to 40-50% to investment returns. So that means doing your ISAs every year, ensuring that you've paid off, you know, you've met your pension allowance, and that you've you know, we look at previous unused allowances and make sure that, you know, you've caught up on those. And now, obviously, with very high earners, pensions have become less of a tool because you know, they are tapered away effectively, and so clients look at other potential products to minimize their tax liabilities. And this is something that we advise on. So professionals very much are the core of our business, and we know how to approach them, we know how to work with them. And we know that the specific challenges they face. Yeah.
And the regularity of savings is important, isn't it? Into whether it's ISAs or pensions, even when at the moment, obviously, financial markets, there's a lot of volatility, but just the regular habit of just accumulating, you know, a nest egg for the future, regardless, month in, month out, is important, isn't it?
Yeah, we're very keen on stressing that. But the good thing is also with having a bespoke relationship with the financial planner is that we're here to remind you if you miss deadlines, if you miss tax deadlines, that you should be sort of catching up with your allowances, with your you know, with your unused allowances, etc. So we're here for that. We're here to take that slog away. It is actually a bit of work, and it requires time, which our clients generally are short of. So this is something that we offer. We are, amongst many other things, time savers. Certainly at the moment, for clients aged 40, 50, you know, with a good 15, 20 years of accumulation in front of them, these are fantastic opportunities to increase their weightings, and their returns obviously are higher, you know, when you buy at a lower price over the longer term, if history is our guide. So you know, it's important to, as I've said before, to take the emotion out of the investment process, and regular savings or focusing on long-term goals really helps do that. and clients appreciate that. And they also feel much more relaxed at times like these, where you're prone to panic. And this is something that can be very, very hazardous to your wealth.
And what about business owners? I mean, they have a different profile in a sense that they're building wealth perhaps in a company that then over the longer term has value, but year to year they're responsible for their own pension savings, and not forgetting that in the light of trying to build a business. What kind of things come up with business owners?
Yeah, so business owners are different. I mean, there are different types of business owners. So there's sort of the lifestyle business owner who doesn't really put so much of a value on the business, and you know they have similar needs to professionals effectively. But you know the big disadvantage with business owners is they don't have employers who are paying into their pensions every month, you know, or matching their contributions. So they need to catch up to the professionals who are being helped by their employers quite a lot, which makes it more important to try and save. For the business owners that do have a business which is ultimately can exist independent of them, yes, it would be wrong not to include the business in the overall financial plan and the potential sale of that. So that we don't say we're not ultra cautious and we say, oh, you know, you don't know the value of your business. No, the value of this is your business. You've worked on it, and it has a value. And all business owners should be thinking of an exit at some point, because that's what business owners should be thinking of. So we will help them with that, and we will certainly. We delve into different roles. Actually, we're more sort of management consultancy. We work with management consultants and tax consultants to try and help them build the business up so that it is in a position to be sold. So we'll help business owners understand how much they need to sell their business for, and then when they've taken that decision, then we will help them do their best to try and sell it. And then after they sell it, there are lots of tax considerations, how to minimize their inheritance tax, how to minimize other taxes that they pay. But also throughout this process, obviously, we do stress to business owners that there has to be a plan B, and a plan B is building up your liquidity and your resources outside of your business as a backstop if something goes wrong. So we do stress that, and clearly the pension arrangements are probably one of the best ways of extracting value from your business tax efficiently, because you can effectively take the money out of your business, and that is that is free of any dividend tax or income tax to the business owner, and it is also reducing your corporate profit. So it really is a great way to de-risk the future for business owners, so they rely less on their business and they have a backstop, and also it's a really good and tax efficient way to save money. So that's something that we help business owners with, certainly.
I mean, another type of liquidity event outside the corporate arena is in the personal life around an inheritance perhaps, or a divorce. There might be new clients who haven't been used to actually managing a portfolio of assets, not sure where to start. What kind of support do you give people who are coming to the investment world for the first time?
Yes, I think our profession has found it very helpful to be complicated. It also helps them to charge more fees. So we do try and be as simple as possible in terms of investment and our investment process. We are firm believers in simplicity, in the principle of Occam's razor. You know, the simplest is the best, certainly for core portfolios. So that means very much an evidence-based passive approach. You know, we do tend to think long term, and we do try and get this across to clients that if you have need for liquidity in the short term, you shouldn't be investing it. And when I say short term, I mean even anything up to the first 5 years, you should keep in cash. If you have a liability that needs matching, you need emergency money, anything in the short term, liquidity is best and cash is best. And don't worry about inflation and all that stuff, because ultimately what we need to do is preserve capital in the short term. But anything longer term, then we need to talk, we need to talk and have a sort of long-term approach and look at investing. And investing is quite simple, really. It's not difficult. We create a globally diversified asset allocated portfolio, which is tailored to the risk profile of the client, and also takes into account how long they have to invest for. So somebody investing for 20, 30, 40, 50 years for their grandchildren is a different investment approach for somebody who looks to draw down in 5, 10 years in the short term. So, we take those into account. And the portfolios that we offer are extremely low cost, because we think cost is one of the biggest factors in investment returns ultimately. And the lower the cost, the more you're comfortable and sure that your investment returns will be higher in the long term, all other things being equal. We're very humble. We don't think that it's easy to beat these markets. Markets are extremely well analyzed and well traded, and there are millions of different computers and people trading events behind the scenes. It is extremely difficult to have an edge in this market, and that's why we believe that we don't have an edge, and people who think they have an edge generally don't. So we don't think clients should be paying for that. So as I said, very simple, very transparent, and very easy to understand approach. And investment is, I think, will be more and more commoditized as we go on. And this is not the value that financial planners, wealth managers add. The value is in all the other stuff. This is what we need to get across to people.
Okay, interesting. And I know also you have a capability around looking after US clients who are perhaps over here in the UK. Perhaps tell us a little bit more about the type of clients you're looking after with that profile over here.
Yes, so US clients are, so US expatriates living in the UK are sometimes, well, they are faced with some difficulties, unfortunately, because of the US tax system and how that views US citizens. So the US system is one that taxes its citizens wherever they live. It's one of the very few systems that does that, unfortunately. And this sometimes comes into conflict with the UK system and the UK tax allowances and all the UK investment wrappers that we have in this country. So we're here to demystify that. If you don't do it properly, you could end up potentially foregoing all of your return in tax, which is something we want to avoid. Things like ISAs, for example, which are extremely popular in the UK, the US tax authorities just look straight through that and ignore any tax benefits there. So clients should be aware of that. There's no real tax benefit for that, and it could even be a potential headache in the future. So we tend to avoid those. Also, clients who are buying, US clients buying portfolios of UK funds, they fall foul of these passive foreign investment company rules, which are US rules. And again, these investments could be taxed punitively. So it's important to have really compliant investment advice, which we offer. We work with some of the really specialist discretionary managers who tailor portfolios that are fully compliant with US law. And we also work very closely with US accountants here, accountants in the UK who cover US jurisdictions and the UK, and so that we can give truly joined up advice and make sure that clients are fully compliant and that they don't make any mistakes, because mistakes for the US citizens can cost quite a bit, unfortunately. So that's something that we do. Not many people do that. We embrace this challenge. We think that financial planners are very, very worried about liabilities and this and that. We are, we embrace these type of clients, and we think more planners in the UK should do as well in the future. Yeah.
Thank you. And you mentioned at the top the independence of your firm.
Yeah.
And just for the investment process, then I guess clients might feel they take comfort from a large brand, or think, oh well, there's all the resources there within that large company. How do you make sure that you've got the resources there and that your independent approach is delivering? Perhaps you could tell us a little bit more about how you really go about funds, perhaps, or managing those assets.
Sure. I mean, let's be clear, we don't have discretionary permission. So we are an advisory firm. So we're not taking decisions and making timing decisions behind clients' backs. That's important. So we've set out some clear ground rules in how we work. There will be a quarterly automatic rebalancing if there are funds that move within a 10% band. There's a strict set of rules that we go by, and every year, so we don't invest in single stocks. We invest in funds. These funds are some of the biggest managers on the planet, such as BlackRock and iShares and Vanguard and LNG and these HSBC. So in terms of our risk, I mean, all we're doing is we're due diligencing these portfolios once a year. And by due diligence, we look at a filter. We use all the resources that are available to us and that are available to all the asset managers. We don't pick fund managers on the basis of performance. So we filter for cost, we filter for tracking error, we filter for size of the business, and we feel comfortable with our selections. And we always, though, have an independent oversight to our. So this is always sort of given a second look by an independent firm that comes in and does the due diligence on our due diligence effectively. So we think that provides a separate label of comfort to clients. We, in terms of where clients' monies are held, they're on some of the biggest platforms in the UK, custodians, which allow us to run the portfolios in the way we want. And all this basically reduces cost for the client, because we don't add another layer of investment manager costs or manager costs that would just take money away from clients going forward. So we think that that's not necessary. And we don't think that that there's anything, as I said, we don't believe that anyone has an edge. So we don't think that that these extra costs should be paid, really. Yeah.
Because you're not looking to find the star active managers,
no.
Pick out personalities. No. It's really, like you say, across the market, getting market exposure through passive investments.
So for the 90% of clients, even up to a certain amount, that is all you want. So sometimes we do look at more complex investments, such as, for example, tax efficient investments, such as venture capital trusts and enterprise investment schemes. So these are useful for the right client with the right risk appetite, and who has basically maxed out on everything else. For this, we are really big fans of diversification, so that we don't end up too much with one manager, and we have a really big portfolio of underlying shares and underlying businesses, because we do see risk in these businesses going forward, and we do see risk in managers, and that's why we due diligence them. The great thing is our business, Valid Path, our network, is, I'd say, a market leader in the due diligence of these types of products, and in the research and analysis and portfolio management of these types of issuers and types of wrappers. So we really do rely on them, and the amount of work that they do and the amount of due diligence that goes into it gives us comfort that that we're advising the right thing for clients.
Okay, terrific. And also, are you seeing any interest in ESG driven strategies for fund managers or sustainable investments? Is that filtering through to your clients talking about it, or what's your view on that?
Yeah. So for us, if you have clients that come in who are very, very adamant that there are certain sectors that they don't want to invest in, then we will accommodate that, definitely. So this is a strongly held belief about a sector which they think is not contributing to the environment, it's not contributing to the sustainable goals of the planet, and they would like these investments not to be in their portfolios. So this is something that we certainly can accommodate, and we can offer a range of solutions which are quite low cost that will accommodate these types of beliefs. We don't think that this should be a default position for clients. We believe that the managers that we select, which are some of the biggest managers on the planet, such as BlackRock, Vanguard, and HSBC, are effective stewards for these types of considerations. And we see more value in a big holder of oil assets trying to push for change rather than trying to exclude things or trying to be smart or trying to do other stuff. So we think that that there is something to be said for the activist side of some of the big index fund managers, and we embrace that. We think that there's a lot of risk for clients only investing in these types of things, and you know, that there is potential loss of upside and extra risk, which on the whole we're not comfortable with. So this is not our default choice. However, as I said, if people are very, very strongly convinced that the certain aspects and certain investments shouldn't be in their portfolios, then certainly that's something we can accommodate.
Fantastic. Well, look, great to talk to you today, Philip, and we look forward to sharing this with our members.
Thank you very much. Thank you for your time.